morning, everybody. Welcome to the Breakfast and Money Show. I am Robin Roberts, and today we will meet John Mason, who will be talking about how bond market and stock market are related. Please send your questions with the hashtag MasonAnswerMe, and we will be delivering your questions to him.
Still not live yet? How am I supposed to explain these concepts to simple, non-financial mortals? Okay.
Hello, John, can you hear us? John?
You sure it was at this time? Because they're telling us they're not live yet. Are they live? No? Do they not know about punctuality? You know, that's why I hate coming to these things. That's why I never book them. No, yes, I can wait. No worries. Where do I even look? Here? Yes? Oh, okay.
Mr. Mason?
Like this.
Are you there?
This? No. Oh. Normal. Oh, okay. Okay.
John, can you hear us? Can you?
Oh, hi everybody. Hello. Hi, public. Yes, I can hear you.
Oh, hi everybody. Hello. Hi, public. Yes, I can hear you.
Good morning, Mr. Mason. First of all, thank you for answering our call. I will be reading some of the questions simple mortal, non-financial experts ask us. And the first one is, why is it that the majority of times the bond and stock market have an inverse relationship?
Okay, well, answering your first question, it is important to know that when stock prices get higher, it usually means that the economy is doing better, and that means that each company is gonna receive even more profits.
Okay, so companies will demand more goods because they have more money, and this can cause inflation too, am I right?
Yes, that is correct. So in order for the Fed to control this type of situation, to control the inflation by the demand, they start to increase the interest rates so the bond prices can be pushed down.
John, what will happen if the company is not doing so well?
Yes, that is another possibility when the economy is not doing well. And when this happens, the stock market tends to fall because there is a higher risk when the economy is not doing well. So what the investors do is that they flee and take all their money to the bond market. So what this provokes is that all the prices from the bonds will start going higher and higher and higher, since investors are demanding more of these safer instruments.
I see. So tell us, John, and I guess this is the big question. What is happening right now with the markets? We just spoke with one of the best teachers of all universities in the world, Rodrigo Quintanar, and he told us that the stock market and the bond market, are both growing. What are both markets expressing about the current economic conditions?
I mean, I haven't heard about this Rodrigo Quintanas. No, I haven't heard about him. By what you say, I guess he's in the financial area of sorts. Okay, well, yeah, he's right. This low economic growth has provoked a low inflation rate. Why? Because people are not consuming as much anymore, or at the moment, and this is not letting the economy grow, and since there is no demand on goods, the inflation rate isn't being increased. So of course the Fed is deciding to not interfere in this, because they need what? They need to let the economy grow. So they need to do this by activating it and letting people consume, so they don't have the need to interfere in raising interest rates or pushing bond prices down, because instead of needing that, they need people to consume, to activate the economy.
Okay, so inflationary expectations are lower than expected, but what effect does this have on the economy? How would you expect bond yield rates to react?
Yes, exactly. So what this means is that the inflationary expectation was lower than what they had projected. So the Fed is giving out the message that they will not rise interest rates at the moment. So the economy starts to activate even more. And this is a message they have been transmitting towards principally the bond markets, because what they need is for people to consume in the economy, not invest in savings, but to activate it by consuming different types of goods, so the growth of the economy can be more punctuated.
Now we have this question: what has changed about the Fed's monetary rate policy, and how does that affect the stock market?
Yes, very good question. So the Fed had announced that they would have 3 increments throughout the year for interest rates. But now, seeing the results that they weren't what they expected, they have now recently said that there probably won't be even a single raise of this interest. Why? Because they need to continue to activate the economy.
Well, that sounds good. Finally, a student from a university wants to ask you, according to what you stated in your column published last week, why do you believe that the bond market is the one we should all be following?
Yes. Well, to this kid, you should give him an extra point. Good question, mate. Or girlfriend. The bond market has its importance regarding the interpretation of the economy of a country. So it is important to have a sort of following up to this market, because the bond market gives us the performance of how the economy of a country is going. It can tell us if it's going slow, if it's not increasing enough, if it's increasing rapidly. And thanks to these types of interpretations, we can sort of expect what the Fed will do and how will the Fed react. For example, if the economy is low, well, and we obtain that information thanks to a bond market, we can assume that the Fed won't rise the interest rates, so people can still consume and the economy gets activated. On the other hand, if the economy is moving too fast, then inflation rates are going up. And what would the Fed do? Well, when this happens, they tend to rise the interest rates, so the bond prices lower down, and then people invest. So it's a really great way to have that projection.
Excellent, that's it. This was John's opinion about bond stock markets, and we will continue the discussion on Twitter. Stay tuned. Thank you very much, John, for joining the show.
No. Thank you guys for inviting me and having me here. I really, from the bottom of my heart, I enjoy this. I really do enjoy explaining concepts of our financial markets and how they're going. Yes, of course. But, well, thank you so much for having me. I appreciate it. And, well, hope to see you soon. Bye. We're done? Yes? Yeah? Oh, finally! I don't get paid enough for this. So can I leave now? Yes, okay. Ugh. Mom, bring me my onion bagel. Yes.